Thanks so much for tuning into this conversation about, well, you could say value investing, because the classic debate of value versus growth has never been as strong as it has been in 2022. Uh, it's on cue that the Value Discovery Fund of ICICI Prudential AMC is completing 18 years. It's given tremendous CAGR performance in its life cycle. And the man who looks at, I presume, value investing in the whole of the AMC, and it's probably known as a value investor across the country, and who manages this fund as well in some fashion or oversees this fund, S. Naren, is with us to talk about, I could argue, that very debate. Naren, great having you. Thanks for talking to us again. Um, where are you? I know you've traditionally been a person who's got a bent of value investing to himself, and please correct me if I'm wrong, but where are you on this debate currently? Because it's after in a manner of speaking, it's after some time, 2 3 years, that we've seen value outperform growth in a meaningful way.
Yeah, this debate keeps going on, and I am of the view that the central bankers distorted capital, and just printing money on a scale which was unbelievable. What happened was they managed to distort this debate, and I think whenever you have central bankers managing to print large sums of money, you're going to be able to not justify value investing. So in 2020 was one of the toughest years for value investing, primarily because the central bankers across the world printed money on a unbelievable way. So we had a tough time in 2020, but in the finally at the end of the day, logic has to work. What is value investing? Buying something below intrinsic value and waiting for it to work. Can that go out of favor in the long run? The answer is no. Can it go out of favor in the short run? Certainly yes. Because in the short run, market is not something which is going to behave the way I want it to, or ICICI wants it to, or anything like that. It can work in any way depending on what buyers and sellers want it to do. So that is how we see it. So periodically there will be periods of time when there will be a lot of articles saying value investing won't work. Even the legendary Warren Buffett was written about in 1999 that he is not a good investor. But he has been proved right
Right.
later. Because at the end of the day, eventually value investing will work because it is logical. But there will be periods of time when it won't work.
Okay. Do you reckon that this 2022 has ushered in the period of value investing which will last for a long time now? Because in our interview last week, you did mention that you believe that central bankers will not now be printing money at a scale that they have in the recent past. So therefore, does that usher in an era of value over growth for the medium term?
Yes, I'm a believer like that because if you look at the last 18 years, which are the periods where value investing didn't work? It didn't work in 2007. It didn't work in 2016, 17. Didn't work in 2020. So if you have a period of time where there is extreme bullishness or something like that, or where central banks actually print large sums of money, in either of these kind of cases, it hasn't worked. I don't think we are in that kind of a situation. Right now, the central banks are very clear that they have to actually defeat inflation.
Hmm.
So at this point of time, they have to behave rationally, actually tighten liquidity, remove liquidity from the market, increase interest rates. So in these kind of periods, clearly value investing has a good chance of working. Can equity itself deliver very big returns? That we can have a debate on. But will value has a good chance of delivering good returns within the equity space? I believe so.
Okay, Naren, a quick introspection, if you will. The last 18 years of your fund, you've had tremendous results. Have these largely been even and steady in nature? And if so, I would want to understand that how have you managed to do that even in periods wherein uh, growth beat value investing hollow?
They haven't been steady. That is the reality. In fact, it's best to talk about the distant past, like 2007, 8, 9.
Mhm.
When I was running the fund in 2007, in 2007 December, people used to ask me, "What is this value? It's underperformed so much."
Mm.
It was a year where the fund underperformed by I think 13 to 15%, and people used to get completely distraught by the underperformance of value. But if you measured the fund in 2009, the outperformance was there even on a 3-year basis. Because in 2009, the outperformance was so significant that even the 2007 underperformance was taken. So I think there is nothing called being very steady. And that's one of the reasons we either tell people to invest for the long term or do systematic investing.
Mm.
So there can't be a period where you can always say we will do well or something like that. That's not something any value investor believes and says, that you can have steady returns. But what happens is, because you're doing something logical and rational, you're very confident it will work in the long run. And that's why we are very confident that the 18-year experience in value discovery was good. But there have been periods in between where the 3-year experience wasn't good, but the 18-year experience is good. The 10-year experience was good. I think over a 5-year period, the experience was good. But there have been periods, even 3 years, where the experience was not that good.
You may not have been as wise as you are now back then. Uh, did it impact you when there was such a serious bout of underperformance? And what did you tell yourself then?
Clearly, it impacts you. You're not managing your money, you're managing other people's money. You're responsible for other people's money. So you have sleepless nights, because when you're managing other people's money and you have not given them a good experience, it causes sleepless nights. But then we used to think about what Warren Buffett would have gone through in 1999, when an article came saying that Warren Buffett doesn't know how to manage a growth period, but he knows how to play bridge with Bill Gates, but he doesn't know how to buy Microsoft stock. He eventually went right. So after reading such articles, one got confidence that one has to stay the course. One can't buckle and say do things at the wrong time. So one has to be systematic and stay the course. And that was a lesson that we had learned even in 2007. So I believe that the important thing is you have to stay true to the process
Mm.
and stay with the process. And once you stay with the process, the returns are likely to come. And that is the lesson that we had learned by watching the other greats. So we just followed those principles, and that eventually worked. But there have been periods where it was not easy. I would say even October in 2017, my colleague Mrinal, who was running the fund, also had a difficult time at that point of time. So I believe that periodically you are going to have this, but that doesn't affect. But look at the 18-year track record, or look at 5-year track records.
Sure.
It showed that value investing is a good style. But and see, and there is nothing like you can make money easily. If
Of
you can't
course.
make, if you can make money so easily, why do you want to work?
Yeah,
It
yeah,
can't be. So that's why value investing as a style has worked for so long for so many people. And that's why you have to be, patience is a very integral part of value investing.
sure. And then when you talk about, or when you follow your value investing process, there are people who find value in growth, and immediate growth at that. So it may be available cheap, but there is a promise of growth almost visible. So it may not be available dirt cheap, but it's available slightly cheap. And in some cases, like I remember a BQ Edge event that we did in Chennai, maybe 3 4 years back, if I'm not sure. Back then, nobody could forecast how the earnings of telcos would come like, but you were confident. You went out on a limb and spoke about buying telcos, or even the metals call that you were given, right? There was no immediate visibility in earnings. So what's your practice of value investing? You buy it on a thesis of a cycle turning few quarters out, or in some sense you favor buying something which is starting to get priced in but not fully priced in, and growth being visible near term?
So we actually ask ourselves, do we need the product? So if you take telcos,
Hmm.
telecom, uh, could I live without my phone? I could not live without my phone. It was easier to live without my purse than to live without my phone.
Sure.
So if telecom stocks keep on coming down and I cannot live without my phone, so it was very easy that I could buy telecom and I could keep on averaging it downwards because I couldn't live without my phone.
But that did not mean earnings will come in.
Earnings, no, as long as a product is so much in use, eventually you can't have everyone going bankrupt because everyone around me needed not only a phone, they needed an iPad or a tablet or something like that, multiple products.
Sure.
So it looked illogical. If you take the metal call, I realized that everyone around me was buying automobile stocks, consumer durable stocks during COVID. They were all buying companies which were making, for example, something like any air conditioner or something like that. But they felt that air conditioners could be made, but metals were not needed. It looked very logical that you needed metals to make air conditioners, so, or dishwasher, for example. So it looks so logical that metal stocks can't go to zero because metals are needed to make cars, it is needed to make dishwashers, it's needed to make air conditioner, it's needed to make a fan. So it looks so logical that metal stocks can't go to zero. So if people said it went to zero, it was very easy. There was a time when oil went to zero in the market, so it became very easy to predict that oil can't go to zero because you need oil to run your car. So certain illogical things will happen periodically, and the difference is that you don't know when it will turn. The important thing is you don't know when it will turn, and people who are value investors don't say it will turn on this day. You have to take that bet that oil can't be zero because we all need oil. So that call, when you are willing to take, it's very easy to make money because you know that you can't live without oil, you can't live without steel and aluminum, you can't live without your mobile phone. So those calls become very easy because when you're buying it, you're actually buying it after a very, very big fall. If you look at the kind of prices at which you bought them after 50, 60% fall. And that is the way value investing works.
Interesting. So, Naren, do you find value right now in a market which is looking to some people's minds stretched? I think, as we also spoke in our conversation, India as a market is second probably only to the US, and amongst the emerging economies, probably the most expensive as it has been. But is there value there within the market per se?
If you're looking at it today, we are somewhere in the middle. So that's why we are neither in greed nor in fear. So what we do is we recommend asset allocation. Within that, we find that there is value in floating rate as a category because it's one of the interesting categories where interest rates has been going up and the product, which is floating rate, has been going down. So we see value in floating rate. Otherwise, if you look at it, by and large, we are in the middle. So we are in the middle. So it's not that all the time you need to be in the extreme.
Got it. Okay.
So people think that you have to be in the extreme all the time. You need not be in the extreme. And one of the reasons why we popularized asset allocation as a theme was markets can be in the middle like they are
Got
today.
it. Got it.
If you find markets at an extreme, one of the lessons we learned is that we always want markets to capitulate and be at an extreme to give a buy call. Just because you want markets to capitulate doesn't mean markets have to capitulate.
True.
If they occasionally capitulate, like March 2020, you can give a very big buy call. But if they
As you
don't
did.
capitulate, then don't give an extreme buy call. Give a middle of the road call.
Okay. Yep. And I remember that. I mean, I don't remember the exact words, but I do remember that at that point of time, you guys were of the belief that people should put their money to work in equities. Yes. So right now, you reckon that there is value in select areas in the debt side, not on the equities side.
In the equity side, you're in the middle. You're neither.
But that's for the benchmark.
Yeah.
Are there pockets within that, Naren, that you reckon have value uh, to be taken?
Clearly, if some of the PSUs are definitely attractive at this point of time, I would say financials are certainly more attractive than many other parts of the market. So there are sectors which are okay, and I would say healthcare is certainly more attractive than other parts of the market. Uh, Clearly, there are sectors. I would not say that the market is very costly everywhere at this point of time.
Got it. Then one final piece of advice for people who are watching this, and so we are like I said, we're talking on the eve of the 18th year of your value discovery fund, 20-25,000 crores AUM, if I'm not wrong. For people who are looking to make fresh investments into mutual funds, not direct equities, but mutual funds, would you reckon asset allocation funds are the right way? Would you reckon balance advantage funds, or would you reckon debt funds are a good theme from a near-term perspective?
See, I would definitely think systematic investing
Yes,
in equity funds,
in equity funds.
like value funds and various other funds, also should be considered, along with lump sum investment in asset allocation funds and lump sum investment in debt funds. So I think all three should be considered at this point of time.
Great. A bit of a masterclass, Naren. Thank you so much for this. Much appreciate you taking the time out and talking to us.
Thank you.
And viewers, thanks for tuning in to this very special conversation.